What's going on, everybody? Welcome to a Capital Hungry Market Analysis and Trade Ideas webinar. It is currently roughly 5:30 p.m. Eastern, end of the North American trading session, Monday, September 18th. We're just going to be continuing from our previous market analysis and trade ideas, where we've had some trade ideas play out, but not last that long. Other asset classes really didn't do anything at all and still ranging, and some trade ideas still potentially setting up for the days to come. Now, we're just going to do a quick review of what took place to start out this new week so far. In the example of gold, we were looking for pullbacks to the 1930s and some potential high risk, high reward sell plays, whether you're scalping or day trading it. The reason for that was we were still failing to break above this important liquidity zone. And last week, we still ended up closing below, just rejecting around a little bit below the key level around 1923 here. So to start out the new week, we had the pullback phase over the Asian session hours and started to show signs of rejection later into London session, still getting some very nice rejections and clean sell plays from 1930s roughly to 1923. But because of the lack of events, housing data still being relatively softer as well, and that was the only thing in focus, and dollar entering a deeper secondary phase of market structure, breaking below the consolidation zone, having a pullback to the first area of interest being at least previous highs, gold later in the day started to break higher. Now, New York session volume was relatively skewed, as you can see here. During the prime of the New York session, price action was terrible. The pullback overnight was pretty clean. The rejections and sells back down were pretty clean. But we had this heavy indecision as dollar was ranging and didn't start to get this breakout above the 1930s until much later in the day. Now, we have to be careful as dollar is still flat and gold is still maintaining a bullish sequence of events as it's breaking above this very important price sensitivity area, roughly at the 1930s. If dollar still remains relatively softer and we still see gold holding above the 1930s, then we're not obviously going to be looking for any more sells, as we still don't really have any important events to bring dollar strength until the second half of the week. We could see dollar relatively softer and gold still holding some demand here, easily going back up into the 1945s and 1950s before even trying to attempt another sell. At this point, we would need to be breaking well back below 1925 key level to jump back into the sell side bias. Otherwise, what looks like it's higher probability right now is that these sells got faded out. We're breaking above this key price sensitivity area, and we still have active US dollar weakness, which is also leading to the secondary phases of market structure from the lows on EURUSD, and also GBPUSD being in a secondary phase of market structure at the lows, more just in a consolidation. GBPUSD is a little bit more stalled out compared to EURUSD, because on EURUSD, we already had the ECB rate decision the previous week, which also added to euro weakness, leading to a more aggressive downside play. So now we're having more of a controlled pullback in relation to that aggressive play we had in the previous week. But in the example of GBP, even when we're looking at GJ specifically in GBPUSD, because both of these currency pairs have rate decisions this week, Bank of England, Federal Reserve, and Bank of Japan, we can see prices relatively subdued and less volume and volatility. So that's something we still have to keep an eye out for on GJ and GU until we get the FOMC and the Fed rate decision. And then, of course, Bank of England rate decision and Bank of Japan release. USDCAD was still respecting pullback structure on softer dollar, but is still holding this high risk, high reward demand zone for the time being. UJ has seen some of the worst price action I've seen in a while in terms of how tight this consolidation was of maybe ranging a maximum of 15 pips here since the market opened. And equities were relatively mixed here, where all we had was a very short-lived scalp move. And outside of this move here, which obviously went to retest the better sell side liquidity zone, you can see we're starting to play in this general intraday range until we have more important fundamental catalysts unfold. So you can see outside of this price grab, which was short-lived upside to retest the better liquidity zone of interest for sellers to jump in and buyers to offload. Besides that, US 30 here has primarily been sitting within this range and looks like it's going to remain there as global equities still remain relatively subdued. So volume and volatility conditions still aren't the best, but it does look like we're still going to have some short-term dollar weakness as long as we hold below 105.2 here. And then if we break below this first area of interest and just notice dollar having a deeper pullback phase, dollar retesting this liquidity zone into the 104.5s again would not be out of the ordinary. That would obviously correlate to gold still holding some bullish demand above the 1930s and pairs like EURUSD and GBPUSD having some aggressive pullback phases as well. This may cause a little bit of indecision on USDCAD, but USDCAD, we're still focusing on those important intraday prices because we still haven't broken structure yet. We're still holding that demand zone. But the key intraday prices I'm looking at on dollar is obviously key level here, which is previous highs. New intraday highs at 105.4. This consolidation zone at 105.2. And then 104.5. What information I can take away from this is overnight with how the economic calendar is still relatively quiet, right? We just have some euro inflation figures overnight and then a bit more housing data at 8:30, which regardless we'll do a New York session tomorrow morning. Today, when I was checking out the charts, dollar was just in this very tight range here. And gold was spiking up and down 30 pips every other 5-minute candle, with GJ still ranging and equity still ranging. So I didn't really want to waste 2 hours with all of us just pulling our hair out, staring at the screens and ending up trying to force a trade, especially when we know we have better conditions in terms of more volume coming in the second half of the week. But tomorrow we'll do our session regardless. And if we have less volume and volatility, it'll be more of a psychology training day, but we can also just decrease our risk and take smaller, quicker jabs at the market, playing tighter ranges in areas of interest rather than looking for such stronger volume moves or larger pip plays like we do during data report days, right? Now, in terms of dollar, just as a reference point, what I don't want to see is dollar just snapping back above 105.2, not breaking the highs and ranging again. If we're going to have a secondary phase of market structure, let's at least see a cleaner pullback phase where we see two things occur. One, either failing to break back above 105.2, and two, breaking below 105s here, which is previous intraday highs. This shows me increased probability of a secondary phase of market structure to come retest into this accumulation zone. In this price sensitivity area, after we saw buyers print these higher highs, we had buyers liquidate positions here, sellers jump in hand to provide that exit relief, and then through last week's inflation data, producer price index, and retail sales, we had an accumulation of order flow in this zone, roughly from 104.6 to 104.5, before having another impulsive move, extending trend into these higher highs, right? So this means that if we don't break above 105.2 and we can break back below these previous highs, seeing a secondary phase of market structure to set up order flow into this area before still extending the trend is what looks like the highest probability in my opinion. Otherwise, I can only see I can only see dollar buys if we're breaking above 105.4. So the two areas I see dollar buys are coming back into 104.5 or breaking above 105.4. If we don't get those two confirms, then dollar's just going to remain in a consolidation with skewed price action, making it a lot more difficult to be executing clean trades on dollar pairs. Gold can see a lot more indecision. Equities are going to be continuing to range as well. Inflation figures for Eurozone here. Now they're expected to still be relatively elevated into higher risk levels. Inflation on the monthly change is expected to increase to 0.6%. Inflation year over year is still expected to be at higher risk levels, 5.3%. I can still see these inflation figures elevated, also supporting the pullback on Euro USD from those lows. In terms of housing data, this is already expected to show some declines. If we want to see this lead to some dollar weakness tomorrow morning, it's going to have to come out lower than forecast. Tighter financial conditions, stimulus liquidity running dry, higher interest rates, higher borrowing costs, higher asset class prices, and you're looking at the real estate market. Obviously, the demand for housing overall has been declining, right? So, and we also still have some inflation figures for CAD at the same time, which is also still expected to be elevated as we're digging back into the sticky zone there. So this might lead to an aggressive whipsaw spike on USDCAD, but then still holding that potential demand zone and giving a bounce. Obviously, we still have the Fed blackout period until this FOMC this week. Nothing else really going on from a central banking perspective besides the rate decisions. So on gold and dollar pairs, as long as gold still remains above the 1930s, dollar remains below 105.2, but more importantly, breaks below 105, then that short-term weakness sentiment we can play in the dollar. Now, let me give you an example of what I'm potentially looking for here in terms of a reference point that we can just even look at in the near term. You can see at these highs, you had a consolidation phase created and an accumulation of order flow, still respecting bullish trend, right? Same idea here, right? This is essentially your break and retest an impulsive move, right? This was just the straight impulsive move because with data from last week, PPI being elevated, retail sales still being relatively healthy, and so forth. Now you can see you get these signs of exhaustion where you don't break the highs again and you start to break below that price sensitivity area. Here, it's pretty much this consolidation phase. Now, in this instance, we'll mark in pink. This is what I'm essentially looking to play if we have these price action confirms of breaking below 105 flat key level here. So here you can see Let me make the text a little bit bigger. Exhaustion. What's highlighting that exhaustion? You had a minor pullback. You revisit the same highs, fail to break, right? Exhaustion signs, buyer volume starting to dissipate, having a slowdown, whether it's a lack of fundamental events or a data report that's creating an event-based pullback phase. Then here in pink is your actual pullback. This is an actual pullback phase. This is what I want to pretty much see take place up until FOMC and in the second half of the week, because at least if we have a pullback phase, right, we can take advantage of pretty clear one-sided dollar weakness short term until we continue the overall macro bullish trend. So here, then you can see retest into prior accumulation, pull back from higher highs, fail to break, continue trend. A lot of people wanted me to do the YouTube webinar today, which I might upload this, but I was wondering why they wanted it today, even though some of the more important events are on Wednesday, Thursday, and Friday. I'm not expecting much, even like when we started this week. I wasn't expecting much on the Monday, Tuesday, going into the Wednesday, right? But now, anyways, I'll probably still share this if they want, but maybe not. But anyways, so now we're at this area of interest here with a very similar type of sequence to events where we're pretty much sitting at this point, right? Yes, we had the highs printed. Check. Yes, we can confirm the exhaustion. Check. But we want to confirm breaking below that potential double top area or breaking below the next area of interest, which here is breaking below 105 previous highs. We don't have that just yet. Once we do have that, it looks much more smooth sailing in a repeat of these events in terms of how order flow is moving to see a pretty controlled dollar correction and dollar bears going back into retesting this previous accumulation area into the 104.5s, 104.6s there, right? Very similar to this situation to the left. It's difficult for me to just see any more buys if you're not trading above the highs here. What looks higher probability is just consolidating, or what's even better for us to play from our perspective is a pullback phase. At least when we can identify a secondary phase of market structure, such as a correction, it allows us to still take pretty efficient scalp and day trades, right? Like, for example, let's translate this information. So dollar having this move from about 105 down to 104.6, that 0.4% of movement, right? That's going to correlate very well to GBPUSD, pretty much coming all the way back up to like 1.246s here, previous lows. That's gonna line up very well where EURUSD can literally be coming up all the way back up to 1.077s before fading out the move, right? And that dollar softness plus gold still holding above 1930s, gold can easily be digging deeper into the 1940s as well on that short-term dollar softness up until we get more confirmations from economic data and key events, which the main focus point is obviously the FOMC rate decision. Now, just to talk about the FOMC rate decision in a little bit of a summary, It's like a 99% chance they're going to keep rates unchanged. If they keep rates unchanged, which is already expected, we might see a quick little spike down on the dollar and price setup. But overall, macro dollar bulls are still going to be holding. We're not looking for any surprise rate hikes. We're not looking for them to cut rates or do a 50 basis point hike. That's not the focus point. The focus point is anything within the statement of how long they're going to keep interest rates up for. If they still see that with the last inflation reports fluctuating in the sticky zone, energy prices still being well elevated with oil projected to be breaking $100 a barrel, they may give us the hints and signals that they're not going to be looking for rate cuts anytime soon in 2024. They're going to keep rates up higher for longer. That's going to keep dollar more bullish after a liquidity grab, but not have that much volume, because we understand the Federal Reserve and other central bankers, they don't have to take as many monetary policy actions stuffed into one meeting. During the stimulus phase, every single meeting was about keeping rates cut, pumping the markets, supporting the economy, and so forth. So the markets in Wales rode that greed wave, and all of these asset classes and risk assets exploded in value as inflation also went up, and the Wales rode the wave that was created by the cartel of the currency, right? Then on the flip side, during the dollar domination phase, when the central banks switched their monetary policy stance to start combating inflation, as inflation was starting to spiral out of control due to the extreme stimulus, right? That was the most aggressive rate hike cycle we've seen in history. When they were front loading rate hikes, 50 basis points, 75 basis point, 25 basis point, 50 basis point every meeting, that's not normal actions of a central bank. Those were very unique times. A lot of us got used to having this very large market movement from those events, right? But I feel bad for the traders that started to learn trading or get involved in the markets from the pandemic onward, because they think that that crisis volume and those crisis central bank decisions, they think that's like everyday normal market movement. How central bank rate decisions should go is being extremely boring. Very monotone, seesaw, whipsaw comments, no clear directional bias given, no major changes or policy actions in a singular meeting, stretching actions across multiple meetings, and giving the market very brief signals. This is why we've already done an educational webinar on it. Ever since the rate hikes have been front-loaded and inflation has dropped and the base effect has passed and US inflation is back to struggling baseline levels, right? FOMCs have been boring. We still do our analysis for it. We still do our Zoom sessions, because don't get me wrong, we can still catch fantastic scalp trades. But when I mean boring, I mean compared to the stimulus crisis central banking rate decisions, or compared to the front loading of rate hikes in the most aggressive fashion seen in history, it's nowhere near the same level of volume. Does that make sense to everybody in the chat? Right? It's nowhere near the same. And trust me, it sucks. We were all used to this crisis mode, right? We were all used to this crisis mode. But anyway, so back to what I was talking about. If we can confirm dollar breaking below 105s here, this repetition looks very high probability. It looks like dollar's going to be creeping down to give a correction at least into 104.5s, 104.6s. To me, especially with the current data and information we have, that translates pretty well to a more aggressive Euro USD pullback phase, a more aggressive GBP USD pullback phase. Gold above the 1930s can easily be digging up into the 1940s and 1945s. And UJ, even though volume's been garbage, as we fail to break these highs, dollar weakness short term can easily lead to some pullback phases into the 147s or 146s before attempting any buys. Now, as I was talking about in the last webinar, whenever we identify something like a pullback phase, there's a couple of ways to trade it. So I'm just going to delete this dollar drawing stuff here. So whenever you see me draw this line and mark out some key sell side areas, something like this, right? Sorry, that should be red. Most of the time I'll draw it, but sometimes I'll forget. But what I mean is, if we don't break into any new lows and dollar has weakness, we can easily see a secondary phase of market structure from the lows to retest better sell zones before continuing bearish. This means if we don't break these lows and we break above key level, play that pullback phase, play that secondary phase of market structure until we retest better sell side areas or get confirmations of dollar strength back into the table, right? So in the example of GBPUSD, it gives us very clean-cut information here. If dollar is just breaking back above 105.2 and starting to break into new highs, then clean continuation sells, clean continuation of trend for intraday plays or scalps below 1.236 and 237. Otherwise, if we don't get that, what looks higher probability is this secondary phase of market structure before retesting better sell zones, where I would want you to take advantage of the pullback phase if you're a scalper or day trader looking to trade in these current sessions or conditions, right? So whenever you see me drawing an arrow that we can retest a better area, obviously we're looking for the retest for the continuation trades with trend, but playing that pullback is 100% very valid, clean setups with confirmations from a technical perspective and confluence perspective. If we're failing to break these lows, showing stronger bullish price action, dollars breaking below 105 here, we already anticipating that secondary phase, then you could easily take advantage of a great move like this, where you can catch a scalp there, you can catch a day trade there, up until we retest better sell side areas. Now, my only piece of advice, something that I used to personally struggle with, is that when you catch some of these pullback trades, sometimes ego can come in the way and cloud your judgment from closing the fantastic positions. Meaning, you might catch a rejection at these lows and dollar weakness and GBPUSD starting to pull back. You could be in a buy from these lows and in fantastic profit, but all of a sudden, because you're in so much profit, because you got such a great entry at these lows, all of a sudden your brain starts looking for a reversal, right? So there's plenty of people who I've seen, for example, play these pullback phases, but even though you can get rejections at a deeper key level here or come back below, or just have a short-lived pullback phase and make a resistance at a key level, or something like this to retest key level in previous lows, people will take the pullback entry. They'll confirm failing to break the lows, short-term dollar weakness, and so forth. They'll be in fantastic profit, but then they start ignoring the actual overall structure, and they start hoping for another 100 pips of upside. Hoping we start going to the moon from here, going to the moon from here, going to the moon from here, going to the moon from here. And they can still end up losing or making stupid decisions because they don't close when they should have, just grabbing a piece of the pullback. And then you just end up having price come right back to your entries, more than likely also breaking lower as well, still respecting this bearish structure on macro dollar strength. Does that make sense to everybody? So whenever you're taking some of these corrective trades, just understand mentally ahead of time that you're still playing a secondary phase of market structure and still in bearish structure here overall. You know what I mean? But yeah, on dollar pairs, expecting some of those corrections that can take place to retest better sell side areas of interest. So short-term dollar weakness still looks the most evident. Very difficult for me to see dollar strength unless we're trading above 1054 or get the pullback phase to that accumulation area before continuing the trend. Okay. I can still see equities holding bullish in this range, potentially even coming back to 35Ks again. I can still see gold if it holds above the 1930s, us adapting accordingly and potentially digging into the 1945s. Yen pairs like GJ and UJ still quite messy. When we're looking at market sentiment, yen's still been relatively subdued at these lows, starting to create a support, but not showing any major life. And we know, of course, we have FOMC and Bank of England rate decision. So GJ still been subdued. But in the example of GJ, if we don't break below 182.5s, 182.6s to be printing some new lows and extending the corrective structure, then we could easily still be playing within the range here before seeing any type of better sell-off on a priced in expected Bank of England rate decision. Bank of England is expected to do one more rate hike. That's already priced in. It's already the highest probability. I was showing you guys that in the last market analysis webinar. So Bank of England, it's the highest probability, 81.2% chance they're doing a 25 basis point rate hike. But there is also rumors that they're signaling this is going to be the last rate hike for them, because once they do another 25 basis point, they're going to be well in restrictive territory where they can keep rates up at this restrictive territory and still sufficiently combat and bring down inflation without tipping their economy into a deep recession. Euro Central Bank doesn't have that same amount of freedom. Eurozone is a lot weaker from an economic perspective, not by much, but still a lot weaker compared to like North America or even specifically compared to the UK, right? So Eurozone, with their last rate decision, they're still just sitting around 4% on the implied rate, right? Which is still lower than their current CPI levels and inflation levels. But this is restrictive territory enough for them, because if they do any more rate hikes, they're pretty much going to break their economy, to summarize in simple terms. There's going to be way too many cracks exposed within the European financial sector and within the Euro economy. But what we saw take place with the ECB was last week, they did the highest probability, which was a rate decision at that time, to increase by 25 basis point. And then they signaled that was their last rate decision. And it led to a buy the rumor, sell the news type of play and euro weakness. I can see a pretty similar type of repetition with the Bank of England. If they just do the expected priced in 25 basis point rate hike, and then signal they're in restrictive territory and that they don't really need to do any more rate hikes, that can lead to GBP weakness, which on GJ, in my opinion, would be the catalyst to be breaking lower here and having deeper extended pullbacks. And also, in my opinion, once GU has better price setups, like retesting into 246 or retesting into 251, that's also when we'll potentially see the sell setup on GBPUSD from these previous liquidity zones. First area of interest is previous lows. Then you can see the sell side liquidity that was accumulated at like 251 here, for example. So anyways, on yen pairs, we still got to be careful, because ever since that Bank of Japan headline, we've overall been in this rough intraday consolidation and range. If we don't break these lows, it's difficult for me to be seeing any further sells, especially as we still have Bank of Japan rate decision and Bank of England rate decision in the second half of the week. So price can still be just playing in this range, still pushing to the upside before seeing better sell-off with short-term plays within the range there. UJ is also ranging as well. But yeah, now let's just jump into the direct trade ideas. So with gold here, dollar still remaining softer. Markets hoping for a pause in rate hikes by the Fed, already starting to price that in with the dollar exhaustion as well. Price setups going into the events for second half of the week. Gold breaking above that liquidity zone with only short-lived rejections from the 1930s, still maintaining bullish sequence of events. Would see these buys, wouldn't be attempting any sells unless we dig into that liquidity zone and previous highs into the 1945s. Or if we want to jump into sells from current prices, we need to be breaking below 1925 and 1923s. What looks increased probability is the current bullish price action, bullish structure, dollar softness, markets hoping for Feds pausing rates, taking a slow and steady approach, already setting up prices with some dollar weakness there, yields retreating. Euro USD breaks above gray zone and key level. I can see extended deeper pullback phases to retest better sell zones of interest, or just the safer sells with dollar printing some new highs, us breaking below these lows and extending trend. But what looks higher probability for setups in terms of scalp and day trades are these pullback buy plays on dollar weakness, especially below 105. If euro inflation is still elevated overnight, which it should be, in my opinion, the monthly is already skewed to the upside. Energy costs are quite high with the euro energy crisis going on. And we still can see this pullback phase, short-term upside, which is pretty large pip movement to retest better sell side areas of interest. GBP USD, similar idea. First buy area of interest above key level. Now it looks like we could have deeper plays up to 251 in my opinions, but I would be very careful of how we react just at previous lows. Otherwise, safer continuation sells. We would need just dollar bulls back to the table, weaker UK sentiment, which we might not see till the Bank of England rate decision with a buy the rumor, sell the news play, and a similar repetition if they give signals of no more rate hikes to what we saw at the ECB move in the prior week. USD CAD is going to be interesting here. I can't see any USD CAD sells unless we're really breaking below 1.34s. But I want to be careful here due to the CAD economic data tomorrow morning, which can bring some short-term Canadian dollar strength. And I wouldn't be surprised seeing something like this with a sweep or an aggressive wick or fake out below, and then coming back above, still maintaining USD CAD bullish market structure on the higher time frame, holding this buyer demand zone on the intradays and still continuing the trend. Otherwise, sells would need to be breaking below 1.34s. Now, we have been obviously keeping an eye out on the rejections from this previous price sensitivity area, but holding above these previous highs and this accumulation area here is still maintaining bullish market structure as it's a pullback from new intraday higher highs being printed there. Now you get even more confirmations with the support created and coming out of this corrective structure back above the key levels, but we're still holding this area for the time being. US 30, don't see any more sells unless we're breaking below 34,300s. I could still see buy bounces from 34.5, buy bounces from 34.7. Still looking for another rejection into this liquidity zone sells, expecting choppy sideways markets on equities here. Short-term optimism, maybe by Feds keeping a slow and steady approach, and short-term dollar weakness, but nothing leading into long-term optimism as policy lag effects are going to become more apparent in 2024. And as we're winding down the end of the year, a lot of that stimulus liquidity running dry, tighter financial conditions, equities overall in the macro subdued to some chop markets here. On yen pairs, expecting some pretty messy ranging to occur. Safer sells if we break below 182.5 from a technical perspective, extending that corrective structure we've been talking about from previous market analysis webinars. If we do not break below this price sensitivity area here, would just be looking for high risk, high reward buys in the range, which in my opinion would still be relatively short-lived, coming to like the top of the range here before looking for better sells. Overall, keep in mind with Bank of England rate decision, Bank of Japan rate decision this week, ever since that headline from UEDA on the weekend there, yen pairs, especially GJ, has been more in this intraday range. That's why safer sells is clearly if you break the lows. But if we don't, we could easily still just be having these aggressive bounce plays in the range and still seeing that setting up prices going into some of the more important events in the second half of the week. UJ, short-term dollar weakness, failure to break above these current highs, break below price 147.5, corrective legs down before attempting any buys at 146.8 or 146. Overall, UJ is probably the shittiest volume and volatility out of all the currency pairs we're looking at. At least the range on GJ is much larger. This is very poor price action, but still some trade ideas there. So keep in mind, in terms of market conditions, still no real important events until the second half of the week. It looks like short-term markets pricing in rates being unchanged by the Feds is leading to a bit of exhaustion on the dollar. Further dollar exhaustion and a pullback phase is validated, breaking below previous highs at 105. That gives us more confidence and confirms with gold holding above 1930s that we could still be digging into the deeper 1940s. Euro USD pullback phase, GBP USD pullback phase. USDCAD, be very vigilant and attentive to price action moves after data releases at this demand zone if we do any fake outs and come back above. UJ probably has some of the worst price action. US 30 still looks like we're moving in a chop market sideways. VIX is still flat, less demand in the dollar. If we don't break below 34.5, even if we retest into there, I can still see us squeezing back up into the same liquidity zone before attempting any major high risk, high reward sells again. Let me check the votes. We'll do an Asian scalping and study session maybe today. Wednesday for sure got the most votes. Wednesday after FOMC is a good vote to do the Asian study and scalping session. But we might also do one today too after I save and upload this.